I do want to just introduce everyone to Alison. I guess first, my name is Madison. I'm with EvolveHer. I have been at EvolveHer for a couple years. I do some marketing and brand partnerships, and I helped put this event together with Alison and Nicole from STRAT. So we're really excited to have you guys all here. I do have most of you muted, but I just want you to know if if you happen to have a question along the way, we may be able to get to a few extra. So if that's the case, you can always raise your hand. There's a button at the bottom of your screen. But I do just want to intro Alison and give her some time to talk about what she does with STRAT and how they can help you during these crazy times right now.
Well, thank you, Madison, and thank you to the EvolveHer team. We've been discussing doing a collaboration for a while, so we're really excited to have this opportunity to connect with all of you. As Madison said, this is certainly a crazy time on many levels. We got a lot of really great questions to prepare for this session, so we're excited to really hop in and talk about a number of different financial areas. We're going to cover some of the recent stimulus and opportunities there for business owners. We're going to cover some investing options and things to consider in this market environment. And we're going to cover kind of savings and debt management strategies. So just by way of introduction and background for those of you that don't know me, my name is Alison Bettonville. I'm one of the principals at STRAT. I focus on working with institutions and managing their investment programs, primarily retirement plans, but my background is on the investment side, and I work closely with our investment teams as well as our both advisory and private wealth teams. To tell you a little bit more about STRAT, we are an investment advisory firm. We work with both companies and individuals, and there's a couple of really important things to know about us. We are a registered investment advisor only. We are not brokers, we are advisors. So that means we don't sell anything. We simply are paid by our clients to provide them with advice and guidance in their finances, their investments, and other aspects. That also means we're a fiduciary to all of our clients. That's a legal designation that means anytime we are making recommendations, those have to be in our client's best interest. We can't consider our own interests ahead of our clients, which is really different than a lot of other firms that you may be familiar with from a personal perspective. As I mentioned, we work with both companies and individuals. With companies, particularly, we help them in structuring and managing their retirement programs. With individuals and families, we help them manage their own individual assets for portfolios of $2 million or more, as well as deal with all of the other financial challenges and questions that arise in their day-to-day lives. One of the aspects that we're really proud of is the fact that 2 of our 3 founding partners and 3 of our 6 current partners are women. That's certainly unusual in our industry, and it's an important fact to us and one reason that we're really committed to giving back to women. We have our own internal women's initiative. It's called the STRAT Women's Forum. We've got a lot of presence both here in the Chicagoland area as well as programming in South Florida. And we really publicize a lot of resources on that front. So that's another reason why we're so excited about this opportunity to collaborate with the EvolveHer community. I'll pause there and see if Alicia has joined Madison, or if we want to go ahead and jump into some of the questions.
Yeah, she's on. I don't see her video quite yet. Alicia, can you hear us? Oh, there she is.
Can you hear me?
Yeah.
Yes.
Hi, everyone. I'm so sorry. I was late this morning. I was locked out of Zoom. So I appreciate you guys all coming out, and Alison just did her intro. So glad we got that started. There are a lot of great questions in here. So I was just looking over them. What we are going to do is we've kind of bundled them into different categories and different themes so that we can kind of talk through some of these. There may be some overlap in the questions, but I think the best thing will be is for us to kind of address these, a few of them individually. I'll give them to Alison. And then if you do have a specific, quick question about one of her answers, just raise your hand. If it's brand or industry, or if it's like business specific, you can also send that in chat or as a follow-up, and then we can do some follow-up there. And then if we do run out of time, or if your question doesn't get addressed specifically, we can send a follow-up email to make sure we cover off on everything across the board, because we know everything is changing so quickly. And I know I have a little bit of time after. Alison, I don't know if you have a little bit of wiggle room at the end, or if you have a hard stop, but we can make sure we'll cover those. So with that, I would love to just kind of jump right in. You know, there's been a lot of talk about the PPP and how so much of the money went to the big businesses, which I'm so angry about. And all these lawsuits are coming up now. And then you have CARES and the Chicago Resilient and, you know, other cities. Alison, can you talk to us a little bit about, you know, the state of everything? You know, obviously the funding's run out, but given where we're at, they're probably going to, you know, have some more coming through. But what do you recommend as far as, you know, for LLCs specifically? One of the questions is asking about in terms of utilizing the CARES Act resources, or, you know, the way that you should file PPP. What's the best way to go about it? Should people move their bank account? Should they look at smaller, you know, banks, or is that not even an option to explore right now?
Yeah, so you make a great point. There's a lot going on and things are changing really quickly, but you know, important to note, if you may have heard, the PPP program, the Paycheck Protection Program, has run out of money. They're actively working to add more money to it, and it seems highly probable that that's going to happen. And of all of the programs that were created in the CARES Act or that we've seen, the PPP is probably the most generous. And if that is a resource that's potentially available to you, that seems like the best option for a lot of organizations to explore. So just to dig into the PPP in a little bit more detail, it's intended for small businesses, as Alicia referenced. A lot of things that you wouldn't consider small businesses were able to qualify for that under some of the loopholes in the law, but truly it is intended for small businesses. And it allows you a loan of up to $10 million or 250 times your average monthly payroll. The idea behind this program is to keep employees on the payroll, so it is very focused on what are your payroll expenses. That includes not just salaries, but also benefits like retirement benefits, healthcare benefits, potentially sick leave benefits. And the money can be used for other things. Things like rent, mortgage interest are also eligible there. The reason why PPP is so attractive, really two key reasons. One, you don't have to demonstrate a specific need. That's where you've heard about these companies getting it that may sound kind of crazy, but you don't have to demonstrate exactly how you're impacted. And while it is technically a loan, you don't have to repay it as long as you meet certain criteria, which is based on keeping your payroll intact for 8 weeks. So definitely do some more research. Again, this seems to be the most attractive program out there. It is being administered by banks. So essentially the government has turned this over to a group of banks to administer. And those are banks both that already partnered with the Small Business Administration or that are becoming newly authorized. And I believe we have a list we can circulate as far as who's already on that list of banks. So to the question of moving your bank account, I mean, first and foremost, for better or for worse, because of that design, the program kind of favors companies that already have banking relationships. Obviously, if you already work with a bank that's participating in the program, that makes it a lot easier. If you're not starting to build that relationship, which may require moving a bank account, may unlock access to this program for you in a way that you maybe couldn't otherwise get access. So I know there's a question about kind of how to do it, and it absolutely has to go through a bank. So if you've talked to your accountant or your lawyer, and they may have some advice for you, but to really apply for it, you're going to have to do that directly with a bank.
That's great. And what we can do, we'll follow up with some of the links to the small business resources as far as where to access some of these applications and those different pieces. There's also some helpful different videos that the local government has been putting out to help explain and walk you through that. So we'll make sure we'll send those to you, because I know that was one of the questions, is how do you apply? And they walk through also the stuff that you need to have, because you do need to make sure to have some of your paperwork together. The system's probably better now, but it was very clunky at first. And so
yeah, this was kind of just thrown onto the banks as a surprise. So I know there's been a lot of frustrations here above and beyond the money running out. And obviously everyone's under a lot of stress on the business side right now, but keep at it, keep trying. I think it's reasonable to expect that so long as there's significant demand for money, and Congress is hearing from people, they'll continue to replenish. So even if this next round of funding gets snapped up quickly, that doesn't mean that more funding won't get added in the future.
And then we can also send over a list of, I know a few different women-owned small business grants that you guys could be eligible for. And also Facebook small business, their applications open up today through Wednesday or yesterday through Wednesday. So depending on what city you're in, Chicago is tomorrow that you can apply for that. So they broke it out by region, but we'll include that link as well. Alison, are there any specific women's grants that you've seen that are, people are getting money from, or you've seen movement on, or are positioned really well that you might want to highlight, or we can just...
Yeah, the list is changing really rapidly. There's foundations, more traditional kind of foundations that you would think of that are doing grants. There's companies like Facebook that are putting in grant programs for the first time. So we'll definitely send over that list, and we can try to collaborate to keep that updated as the information changes, because it is changing quickly. I think one thing I would encourage, whether you're going to pursue the PPP or some of the other government programs or a grant, the first step for a lot of those things is going to be good data. So depending on the quality of the data you have today, especially data around payroll expenses and the detail available, that is going to be crucial to both getting the grants and then, to the extent that you're looking at loans, some of the repayments around those. So investing time now in cleaning up those records, making sure you can easily break them down into different time periods, different levels of detail. Even being able to break down by income levels is relevant for some of the programs. That could go a long way in the future as new programs are created and as money is becoming available to make those application processes even easier.
And I have one more thing on this particular topic that you just reminded me of, because I know this was really challenging for me when I was going through the system. I'd love for you to just chime in a little bit about the type of employees that you need to include or not include in this. So certain ones asked for my payroll, my ADP run. We have we have 4 people on payroll, but I worked with a lot of contractors on retainer. And then, so it's kind of muddy waters. And when you can't get somebody on the line, you don't know what to do. Can you talk about that a little bit?
Sure. So a little bit of an echo there. Oh. I'm getting an echo. I don't know if somebody unmuted. Okay, there we go. So there are different requirements for different loan programs. So again, to the data point, if you can classify people, so you can easily filter out independent contractors, part-time, full-time. Income is a big one. So for the PPP, I believe it's $100,000 cutoff for pay. So you can only have your payroll for people who make under $100,000 considered. Being able to filter that easily. Unfortunately, there's no kind of easy line we can say for the programs, because again, things are changing quickly and every program is going to be a little bit different. My recommendation would always be get together your most comprehensive set of data and then structure it in a way that you can easily sort and filter. And then really your banker is going to be the best resource to ask that question to make sure that you're including the right people and that you've got people categorized correctly.
Yeah. That sounds great. And I think even just including a document, because if you're submitting it and they can see everything, then they can filter it down or advise you, and they understand at least how you got to those numbers.
Right.
Are there any questions on the stimulus, government financials, any of that anybody has before we moved on to the investing side?
As we wait to see if any questions come in, I will mention one other aspect. I think there was a question somebody asked about potentially taking money out of their IRA under the CARES Act, which is on the stimulus side. And the answer to that is yes. There is some ability in the CARES Act to take money out of an IRA if you are impacted by COVID-19. That definition of impacted is either you have the virus, you have a spouse or dependent who's been diagnosed, or you have a financial impact. That could be reduced hours, layoff, furlough. The definition's pretty broad there, and most people will probably qualify there. So if you have a financial impact, you don't have to demonstrate that. You just have to call up your IRA provider and say, hey, I want to take a withdrawal under the CARES Act. You can withdraw up to $100,000. And then you have either 3 years to repay that money, in which case you will not have any tax impacts, or you will have to pay taxes on the amount withdrawn within 3 years. So again, you do have some ability to do that. Certainly you want to think about all of the ways you could access funding right now. There are impacts in the long term for taking money out of your IRA and having that money be potentially not invested for a couple years. So certainly consider those factors before taking any kind of withdrawal.
Great. That's really helpful information. All right, so as we kind of look at the market, and obviously it's up and down every other day, and I think we're going to continue to see, you know, the ups and downs, and yeah, it's going to be interesting over the coming months. Do you have any advice or thoughts, rather, on investment strategies and, you know, different precautions that we should be taking? Is this a time to scoop up stacks and, you know, jump in and grab stuff while it's low priced, which my husband likes to do sometimes? He's like, it's down, I got to grab it. But at the same time, how can we make sure we're not burning through stuff in our 401k and all these investments? Can you talk a little bit about how we can be smart on that front?
Sure, yeah. So it might be helpful to just kind of recap a little bit of what happened, because in some respects, what we all lived through in the financial markets in the last 2 months was highly unusual, but in a lot of ways it really wasn't. So we essentially had the high for the market, and by the market I generally mean the S&P 500 US large companies. We had the high in the middle of March, the middle of February. Between the middle of February and kind of the second half of March, the S&P 500 fell about 35% from its all-time high. It was both the fastest decline we had ever seen from a peak, the fastest the market had ever fallen, over 20%, and some of the biggest one-day moves in the market. But markets falling that amount is not unusual, and it's always important to keep in mind on the stock market, you know, the market is reacting in real time to all of the information available, which is usually more information than I have and probably more information than everyone on the call has. So when you're thinking about, you know, your own investments, a couple of kind of general tips to keep in mind. So first, it's really important to know what you own in your investment portfolios, whether that's your 401k plan, an IRA, a brokerage account, starting from that basis of knowing what you already own and understanding how that is or isn't the same as what's being reported in the news. So, you know, I talked about the S&P 500, that's reported pretty commonly, so is the Dow Jones Industrial Average. That represents US large companies. There are companies of all sizes in the US. You might own foreign stocks in your portfolio. We recommend you consider that. You may have bond exposure in your portfolio. So just because, you know, the talking heads on TV are you know, panicking that the market's down a big percent today doesn't mean that your portfolio is reacting that way. So really important to understand what you own. Secondly, always want to consider or always encourage everyone to have an investment strategy. So what does that actually mean? By having an investment strategy, we really mean targets of how much exposure you're going to have to stocks versus bonds and different types of stocks in your portfolio. And we can talk a little bit, and we got a lot of great questions around time horizon. So talk about kind of what to consider for your individual circumstances there. But that goes directly into making sure that you're diversified. So being diversified some people may think, oh, you know, I've got these 4 different mutual funds, so therefore I'm diversified. Well, you want to make sure that you know in each of those mutual funds if they're actually holding different things. If you're are invested in 4 different funds and all of them have really large positions in Apple, then you may not be as diversified as you think you are. You may just have a lot of exposure to Apple, which is a very large company. So making sure that you are truly diversified, that your portfolio is not all doing the same thing behind the scenes, is another important aspect to consider. Timing the market. So major mantra in investments is don't try to time the market. Very often the best days in the market immediately follow the worst days. So, you know, while we had the market fall so significantly in such a short period of time, the market has also already recovered quite a bit of those losses. So those that get uncomfortable jump out of the market after a major decline and try to kind of wait on the sidelines until the market recovers, oftentimes do miss out on some of those very best days. So considering your broader investment strategy and your time horizon, very important when making any portfolio changes.
And there were a few questions in here specifically about, different phases of life. So one of the ladies who have joined us, she mentioned she was in the 60s and in her 60s, and that she has, a comfortable amount in her retirement. So I think, going to what you said, a lot of people, when they get uncomfortable, may or may not pull out. And then another one has a daughter going to college. So looking at these, very timely, specific, looking very specifically at these time frames and these questions that are being asked, should they make a move, or should they wait it out? Obviously we can't predict the future, but it's a very time sensitive situation, and it doesn't look to be going anywhere soon. But is there something they should look for to make that decision, or what would be your recommendation?
Yeah, so a couple of things to consider there. Fundamentally, it all comes down to risk and risk tolerance. And we talk about risk and investments, but we're not always good at saying what risk really means. So here, I would suggest thinking about risk in the terms of the concept of losing money. I think that, naturally, that's what people think about in investments, right? Am I going to lose money? A different way to think about risk is, am I going to have enough money for whatever my purpose is? And we actually have two really great examples provided in the questions. I think retirement is a big goal that I think everybody has at some point of, I'd like to retire and fund my own lifestyle. And then, sending a kid to college and saying, hey, I've got a kid going to college in 2 years. So in both of those instances, a couple of important things to think about. First, probably not going to need all of your savings on one date. So even in those instances, I'm going to retire in a year, I'm sending a kid to college in 2 years. Does that actually mean that you need a certain dollar amount on a certain day? And you can contrast that to something like buying a house, where you probably actually do need to send somebody a certain dollar amount on a certain day. But if you've got a portfolio that you're withdrawing from in a couple of different increments, or many increments if you're in retirement, you think about that as part of your time horizon and how investment growth could work for you. From a retirement perspective, fortunately or unfortunately, women are projected to live well into their 90s now. So if you're going to be retiring into your 60s, that portfolio is intended to stretch throughout your lifetime, most likely. So knowing that just because you're retiring doesn't mean that you're no longer an investor, it just means you're going to start withdrawing a little bit from your portfolio. That could have a big impact on thinking about what is your risk tolerance and the potential ability to withstand losses in that portfolio. The other important thing to consider is kind of how much you have right now and how that compares to what you need. There's a bias in investing on anchoring, and essentially what that lends itself to is the concept of, if I had $15,000 in the college fund at the beginning of the year, maybe now I only have $12,000, and that hurts. Obviously, none of us ever want to lose money in investing, but we can't anchor to that $15,000. We have to look at, hey, if I've got $12,000 now, how much do I need and when do I need it? And focusing on what you have now and what you will need to spend going forward can really reframe the idea of how you should be investing that money, how conservatively, how aggressively. So as we think about risk and kind of markets, wanted to just offer a couple of statistics as you think about general exposure to stocks versus bonds. Stocks, obvious benefits there are potential growth over the long term, but there's that risk of losing money. And so why time horizon becomes so important is, generally speaking, the longer your time horizon, the less likely that when you get to that date, you will have lost money. So just to throw some stats out, the average stock market return for any given week, looking over the past about 30 years, is about 0.2%. So if you just throw a dart at a dartboard, any given week in the last 30 years, 0.2%. So positive return, right? Percentage of the time, 58% of the time. Again, in that 30-year time period, the stock market's been positive for any given week. That means almost half the time it's been negative. But as notable is the range of results, right? For 1 week, that range of results is anywhere from up 18% to down 18%. If we widen that out to a 6-month time period, average stock market return is just shy of about 5.5%. So higher returns. 76% of the time, markets have been positive over 6-month time period. So higher likelihood of positive returns, but a much wider range of results as we compound some of those negative periods. So as good as up 52%, as bad as down 43%. And as we widen out those time windows, you're going to find less likelihood of negative returns, more likelihood of positive returns, and a narrower range of returns overall. So considering how much you can afford to lose is a key component in kind of calibrating potential stock exposure in your portfolio, especially if you're looking at short time horizons. If it's money that needs to be spent within the next 2 to 3 years, the likelihood of potential losses in the stock market may be a more serious consideration.
That's great. And then going back to the stock side of it and looking at, the opportunity side, are there sectors that are best to invest when it comes to recession? Mm-hmm. Or, we're using Zoom, there's Slack, all these different platforms. Mm-hmm. Are those good investments to look at right now? Or what do you think?
Sure. So, looking historically, there are certainly types of companies from a stock market perspective that do tend to perform better in recessionary type environments. Consumer staples companies, think about things that you have to buy. Cleaning supplies is an item that comes to mind right away. Food staples, those type of companies tend to perform well. Utilities, we all still have the lights on, right? Financial type companies, depending. Energy companies, depending. So certain types of companies do tend to perform better versus more, a cyclical company, discretionary purchases. So think about luxury goods. Those types of companies don't tend to perform as well in recessions. Even within sectors, you can see big differences. So think about an area like healthcare. There are certain types of healthcare companies that people need to continue spending money there regardless. There are other types of healthcare companies, think biotech, where that are investing a lot in new research that may not be able to spend as aggressively in recession. So an important aspect to keep in mind, the economy and the stock market are not the same. Generally, we consider the stock market to be a leading indicator. So as I mentioned before, the stock market is always pricing in all of the known information by everybody who is participating. And again, there's a lot of people that are buying and selling stocks that know a lot more than any of us do. So especially as you think about, companies like Zoom, even a Microsoft that can clearly derive some benefits from the current situation. Peloton's another one that has come up a lot. You want to consider not just, hey, I think this company is going to do really well, but also what is the price of that company, and has the fact that these companies are going to benefit from these trends already been reflected in the price of the stock? Usually, but not always, the answer to that is yes. You also really want to consider your own kind of investment objective. Are you just looking for a company whose stock price is likely to go up? Or are you trying to think about a company that's going to do better than the broad market or better than other tech companies, healthcare companies? So depending on your objective, you might consider, an ETF or a mutual fund, some kind of fund that is going to invest in a handful of tech stocks or a handful of healthcare stocks. That's a way to make sure from a risk management perspective that, if you picked wrong and you decided to go with Zoom, but actually Microsoft was going to do better, that you don't miss out on some of those returns, or you're not as exposed to kind of company specific risk factors. Peloton's a great example, right? Generally their stock has done pretty well lately, but we all remember at the end of last year, they had that Christmas ad that was not well received, and the stock went down considerably, right? So those types of issues can happen with individual companies that you may not expect and could expose you to a lot more risk.
Thank you for that. So there's a lot of questions in here about 401k. And I think this is, it's an immediate reaction that I always have when I was in corporate too, when things would go up and down, and the amount that you're putting in there, and just making sure you have that cushion and that safety net for yourself and your family, and that kind of thing. Could you talk to us a little bit about a good strategy to think about for 401k, and if you should continue to contribute the same amount? Should you lower it down right now? And what would be kind of the thought process in making those decisions?
Yeah, great. So on the 401k side, we maybe start on the savings side and then can talk on the investing side too. So from a savings perspective, we always recommend maintaining your savings levels, potentially increasing if that's feasible in your financial situation. That a lot of that goes back to the concept of the time value of money, right? The sooner you can get that money invested, the sooner that it has the potential to work for you. So again, it can be painful to kind of continue putting money into your 401k and then seeing it potentially go down quite quickly. But every dollar that you're putting in is going to be then invested for the longest amount of time possible. And as you think about that time horizon, both to your date of retirement and then beyond through your life expectancy, for most people on this call, if not everyone, obviously can't make any guarantees, the stock market is going to go up, and it will likely be higher when we retire or through our life expectancy than it is today. So thinking through that time horizon, it doesn't really matter for most folks in the short term if they have a little bit of loss in that 401k. The other thing to keep in mind, 401k contributions are limited. The IRS sets the amount you can put into your 401k each year. This year it's $19,500. If you're not already hitting that level, it's a good target to try to get all the way up to that limit. And that's an annual bucket. So you say, I think I'm going to put less in my 401k next year, or this year, and then I'll do more next year. You may run into that limit, and ultimately that's a bucket that renews each year. So trying to hit that limit each year is a great target to support your retirement outcomes. You also want to consider your company contributions, depending on how your company structures a matching contributions. If you're saving less now, saving more later, you could potentially miss out on some of that company contribution. So at least saving enough to get that company match is another important consideration.
Mm-hmm. That's a great point. And just quickly on regarding the ratio of savings, accessible savings versus 401k. So just thinking about, what you need money for immediately, and what would be a recommended ratio for a scenario like this, so that could probably help guide where you're putting your money, so that you have enough cushion to at least cover a little bit.
Yeah, so a lot of things to think about there. Certainly, knowing what you already have, as you indicated, what you already have saved from an emergency savings perspective versus a 401k or other retirement account perspective. But things to keep in mind, again, first, make sure you're saving enough in your retirement plan in order to maximize a company contribution. If you're not, that's potentially leaving money on the table. Do some research if you can potentially access money in your 401k. While we generally don't recommend taking out a 401k loan, knowing that you could potentially access that money before retirement may have an impact on your decision to save more in a 401k plan versus building emergency savings. But, again, if you're in that position where you're like, hey, I've got another dollar, where do I put it? Do I put it in my emergency fund? Do I pay down debt? Do I put it in my 401k plan? There's a lot of things you want to consider there, but I'll throw out a couple of important ones. So first, do some contingency planning on the emergency fund side. There's a lot of recommendations out of there. You should have 1 month, 3 months, 6 months of living expenses. But another consideration is to think through some scenarios and then do some research on how much they're going to cost. If your water heater goes out, what will it cost to replace that? Think of, your dishwasher, things like that in your house. And then how would you access that money? If you don't have it in your emergency fund, can you tap a 401k account? Can you, use a credit card, and what would that cost you? Because that's usually pretty expensive. Other scenarios you might consider, healthcare scenarios, certainly big one. How would you fund a rent, a mortgage? if you were out of work. So doing that scenario planning can help you understand, okay, if I need to go get money, where can I get it from? And then that may help you decide, well, where do I put that money now so that I can access it most efficiently in that emergency, whether it's in my actual emergency account, in a 401k, or planning to use some kind of debt to fund that spending in the future.
And we have a lot of entrepreneurs on the call. And so just a quick question on if you don't have 401k or your company doesn't offer, retirement savings, where can you save right now? I mean, what would be the best option? Can you open more IRAs?
Yep. Yeah, so a couple of things. First, if you work for a company and they don't offer a 401k, tell them to call me. I'm only half joking on that. There are a lot of tax credit opportunities for small businesses to sponsor 401ks. There's a lot of misconceptions about the cost and the work involved. So if you have any questions about that, if you're a business owner or you work for a company that could be interested, please reach out. We'd be happy to talk about your situation in more detail. If you are self-employed, there is such a thing as a solo 401k plan. We're happy to talk to you about that as well. It's a really powerful tool and very flexible. So if you're self-employed or if you're a sole proprietor, as soon as you have employees, that tips you into more traditional 401k, but there's a lot of really great opportunities there. And that's definitely something that, we work with individuals on, especially business owners, and how some of those personal financial and business interest type things can really intertwine. And then again, talk to your company if they don't offer a plan. I think people are often really surprised. I can't tell you how many meetings I sit in with executives where we're making a recommendation to make a change or add something, and the company say, oh, we're not going to do that because no one's asking for it. Ask for it so that they know that you're looking for that. But obviously, you can't just make a change there. Anybody can open an IRA. That's an individual retirement account. A lot of the big brokerage houses offer them. So look for one with low fees, preferably no account fee and no trading fees. You can contribute up to $6,000 to an IRA per the IRS limits. There's some additional ability to contribute more if you're over age 50. And then depending on your income, that contribution may or may not be tax deductible. So you'll have to double check with your accountant and check those income tax levels just to understand if you'll be able to deduct that contribution from your taxes or not. Even if you can't deduct the contribution from your taxes now, there are some ways that you can get that savings to be a Roth savings, which means you won't have to pay taxes on the investment earnings in the future.
Great. Let's talk a little bit about, I love this question. Is it a good time to refinance a condo? I just refinanced this morning, so I'm hoping you said that.
So the first thing I would say, it is always a good time to research refinancing.
Yes.
I think people don't appreciate sometimes that you can kind of shop for financial services. So absolutely research refinancing. Get a couple quotes. You can do a quick Google search to look at current mortgage rates and compare that to your rate. There are a lot of things happening in the mortgage market right now. For a standard loan, that the rates have come down quite considerably. So you may be able to refinance. I do know a lot of people who have taken advantage of that and have reduced their monthly payments. Generally, though, for jumbo loans, the larger loans, those rates really haven't come down. So just depending on the size of your loan, you may or may not have an opportunity, but that all starts with research. You can definitely get some quotes from mortgage brokers. I know I've had success with people saying, look, I'll tell you my credit score, just give me an estimate of what's my rate, what's my monthly payment. And you can usually get that information pretty quickly to at least help you understand if you might have an opportunity.
Mm-hmm. And I know, like for us specifically, if anybody needs like somebody just to talk to, let me know. But for us specifically, I like our guy because he provides various options based off of the risk level. And so for us, that's been helpful. We've used him for years. And so every time we refinance, and then also he looks at the market, and like we were lucky and we got that one day when it was like a 2.78 or something crazy low rate, and we got it. But now the banks can't handle the demand, so they're up higher. So he could say, hey, it's going to go down in a month, or, we're going to see some trends. Like you want to make sure it's somebody educated who can really provide some guidance instead of just the rates.
Yeah, that's a great point. And it's very reasonable to tell someone that gives you a quote, hey, I'm not interested right now, but if the rates move, keep me in mind and please follow up with me. I mean, those guys get paid when they refinance a mortgage, so they are usually pretty persistent at circling back if they think that there's an opportunity with you.
Make them work for it.
Yeah.
Great. Okay, so let's see here. We talked a little bit about, so should I save stimulus versus paying debt? And do you feel like that's kind of a similar?
Yeah, I think one other point I would suggest is, especially as you think about, you've got an extra dollar to save, it's a common question, should I pay down debt, whether it's credit card debt, student loan debt, mortgage debt, or should I save the money? And so the first key step that I would recommend is know how much your debt costs you. And I don't mean your monthly payment amount, I mean your interest rate. So I know my mortgage rate is 4%. I've got a 30-year mortgage, or however many years are left on it, which essentially means I am paying more than I would if I just paid for my house outright. So that's an important consideration for me. And I can think about, if I've got an extra dollar, I could put that to my mortgage and I'm going to pay less off that 4% interest rate. But 4% is not as good as the 2.78, but 4% is a pretty decent rate. And could I do more with that dollar by investing it or by putting it in a different type of savings account? We talk sometimes about the idea of good debt versus bad debt. And generally what we mean by that, good debt is debt that helps you acquire an asset. So mortgage debt is almost always good debt. As long as you can make the payments, you are securing an asset that has value. Credit card debt is almost always bad debt. It's a really high rate, and you're probably not buying things with your credit card that you might need to buy them, whether it's food, clothes, stuff for your house, but you're not buying things that inherently have value that you're going to be able to then sell later. So focusing first on that bad debt, trying to eliminate that, putting a strategy in place to pay that down if you've got it. If you're paying 20+% for credit card debt, you're probably not going to put that dollar in a savings or investment account and earn more with it than you're going to save. One of the benefits of the CARES Act that we didn't mention earlier, student loan debt, a lot of the federal programs, repayments are paused for 6 months, and you're not kind of accumulating interest on that. So this is a huge opportunity. If you can keep paying off student loans right now, you are able to reduce the amount you owe, and that's going to even magnify your savings on the interest side. So that's definitely something to look into kind of in the current environment. On the theme of debt, I think we had another question about, managing credit card debt and the pros and cons of the practice of, opening a card with a kind of 0% interest rate, introductory rate, and then moving or transferring existing debt there, and if that's a good approach or not. So we would say that's a Band-Aid approach. Certainly, it's not addressing necessarily the fundamental issue of paying down the debt. It can help in the short term to reduce the interest and certainly keep you from accumulating more debt, but it's definitely a limited time strategy. First, keeping in mind, anytime you open a new card, that's going to impact your credit score. So your credit score could be hurt if you're continuing to open new cards and transfer balances. And then secondly, that opportunity may run out, depending on how your credit score is impacted and the number of cards you open. You probably can't just continue to open cards and transfer those balances. So really putting in place a strategy to pay down that debt should be accompanied by considering that kind of credit card strategy.
Yeah, that can be really helpful if you have a strategy against it. But then to your point, it can count against you if you start to accumulate all these extra cards. Yeah. Okay, great. And actually, this is a really interesting question. I think it's around the tax benefits and charitable giving. And there's been so many changes in the past couple of years with what you can deduct and what you can't. Is there anything there that we can look at to get some savings or some tax relief on the charitable side?
Yeah, so definitely, I think first, work with your accountant to understand how your charitable deductions impact your tax strategy, and see if you could potentially give more to charity to reduce your taxes. There was a change to tax law this year that impacts kind of super givers, I'll call them. So if you are considering or are giving kind of in the tens of thousands, your ability to give and deduct that has increased. So if that is something that you're interested in learning more about, definitely follow up with us. We'd be happy to talk about it in more detail. That's specifically for cash gifts. But if you have an instance this year where perhaps your tax burden is increasing, there are definitely some opportunities to do more giving in specific ways to reduce that tax burden. And certainly charitable organizations are in especially need of the funds this year.
Yeah. Okay, great. So we've got, looks like about 12 minutes left. I want to talk about just some overarching habits and some recommendations you might have, if we kind of take a step back and looking at, obviously what we have going on now, but then ongoing as we transition back, and just looking at really forming a healthy relationship with money and understanding how we can start to put together routine, a strategy, so that we're not constantly living paycheck to paycheck, or if the water heater or something completely unexpected goes out, obviously to have that savings. But what does that routine look like? What does that relationship with money look like? Are there tools, that you would recommend that help within that? And then looking at, and this is kind of a separate question, but I think it's relevant to that, if you manage your money separate from your spouse or your partner or those kinds of things, overall, like what are just best practices and habits that we should look at when it comes to finance?
Sure. Yeah, so first and foremost, I'll make a general recommendation on the front of kind of habits. I read a great book earlier this year called Atomic Habits by James Clear. Really a powerful book on kind of understanding your own habits and what drives them, whether they're good habits or bad habits, and just tons of strategies to actually create good habits and break down bad habits. So if you're interested in that, I strongly recommend that book. On the money front in particular, using a couple of his strategies. First, I would say, again, as I've hit on a couple times, knowledge is really important. To the concept of living paycheck to paycheck, we always like to say it's really not what you make, it's what you keep. And what you keep is going to be the difference between how much you make and how much you spend. Most people have a pretty good handle on what it is they make. Most people have a really bad handle on how much they spend. So taking some time to really look at what you're spending and being realistic about that. I think you could think of your spending in a couple of key buckets. There's things that you obviously have to spend money on, and no matter what, those bills are going to come due. Your rent or your mortgage, your utilities, those things are fairly unavoidable. So what are those on a monthly basis? How do they change throughout the year? There's other things that we have to spend money on, but maybe we do have some cost control. Food, clothes, our television bills, our cell phone bills, things like that. You have to spend money on a lot of those things, but you do have some control over how much you spend. And if you are struggling and living paycheck to paycheck, you may really need to have some tough conversations with yourself on how much you value some of the things that you're spending money on, even as you start to think about more discretionary spending versus, the lack of savings or the inability to contribute to savings or pay down debt. So really digging into gaining that knowledge for what you're spending is an important first step. Tracking, having a budget. I think budgets, sometimes people have a negative connotation of it's like this thing that handcuffs you and says that you're not allowed to spend money because you have a budget. I like to think of a budget more from the perspective of just, here's what I'm planning to spend on certain things. And then knowing, giving yourself a knowledge level when you've gone over that. And maybe that's okay. I mean, situations change from month to month. One month I might spend more on food. The next month I might spend less on food and more on clothes. And just knowing and having those targets can help you make really good decisions when you're at the store and you're picking something up and you're saying, wait a minute, is this really that important to me? Another important habit tip is automation. There's a lot of great ways to automate some of your financial habits. Most credit cards, you can automate those payments directly with your credit card companies. You can say, automate to pay off the balance on the date it's due. It's a great way to make sure you never miss a payment, never incur any late fees. If you're working to pay down credit card debt, you can often set something up to say, hey, I'm going to pay a certain amount every month regardless. Also automating your savings, having multiple accounts. Most financial institutions that don't have an account specific fee. So, you might have your paychecks going into one account, but then automatically transferring a certain amount of money into a different account. If you're saving for a vacation, if you're saving for, retirement, if you're saving for college education, automating those monthly savings, whether it's big or little, can be a great strategy to help you accumulate money. There's other tools out there that can round up your purchases and transfer, the extra cents to a savings account. It doesn't sound like a big deal, but that money can add up really quickly. So looking into some of those automation tools can be a positive and even can help you avoid bad habits, right? We hear from a lot of folks, I spend money and I just don't even notice it. Consider, if you need to put your credit cards away for a while and just use a debit card, if you need to move money out of an account and just limit yourself to only spending the money that's in a certain account, think about ways you can use that type of automation to kind of prevent your bad habits and flip those into good habits. And then you asked too about if you have a spouse or a partner, managing together, managing separately. So I think managing your finances can mean different things to different people. Our answer is always going to be, yes, you should manage it together. That doesn't mean that you have to consolidate all your accounts and put all your money in one place. But if you have shared financial goals with somebody, I don't know how you cannot be having those conversations. I mean, look, conversations about money can be really tough. What do people like to avoid talking about? It's like death and taxes, right? So having those conversations can be difficult, but they're really important to avoid bigger issues down the road. Certainly know plenty of people who, they're working with their partner to save for a house or save for a kid's education, and then later find out that, they did more than their partner, and that doesn't feel good, right? So having those conversations, even if you're going to keep your own accounts, to just have periodic check-ins, schedule it, whether it's quarterly, semi-annually, annually, to just sit down and recommit to what each of you are contributing to those goals. Another really important consideration if you are married is taxes. You don't want to be doing something in your portfolio that's going to have a tax impact that your spouse doesn't know about. That could lead to an even greater potential tax impact down the line. So being in communication about that. And then we talked before about diversification. You really should think about diversifying on a household basis. It's as a way to manage your investment risk. If you and your partner are both investing towards the same goal and you're doing, exactly the same thing, you may end up overexposed to certain companies or certain areas of the economy that could put those goals at risk.
Great, thank you so much, Alison. I'm going to open it up. Let's see, we got a couple minutes left. I know that was a lot of information, but we were trying to get through all the questions because there's so much to cover right now. So if anybody has a question that we didn't cover that they want to just touch base with Alison on real quick, just raise your hand and Madison can unmute you so that you can ask it. And then we will follow up with kind of a summary and recap of this as well. Anybody? All right. Wonderful. Well, thank you so much. We will send out the information and feel free to reach out for anything. And then also we have these these sessions every other week. So if there's a topic in business that you'd like for us to cover, feel free to send us that too, because we'd love to, just keep a pulse on what you guys need and bring in experts within those different categories and different areas. So appreciate your time today and we look forward to seeing you again soon.